$5,000. That's it. That's your starting capital. And by the end of this video, you'll know the exact stocks that turn that into $41 every single month, 12 times a year, on autopilot. But here's the twist. Most people build this wrong. They chase the highest yields and wonder why their income disappears overnight. I'm going to show you the portfolio that doesn't just pay you this month, it pays you more next year and the year after that. Stay with me, because the last stock on this list, it's the one nobody talks about, and it's doing something your portfolio probably isn't. Let's build this. $5,000, 10% annual yield. That's $500 a year, $41.67 a month. Sounds simple, right? It's not. Because yield isn't everything. A 10% yield today can become a 5% yield tomorrow if the company cuts distributions, and then your $41 becomes $20, and your passive income dream becomes a nightmare. So here's the rule. We're not chasing yield, we're chasing sustainability. We want companies that pay us consistently, grow those payments over time, and don't collapse when the market sneezes. That means we're building around 3 pillars. Diversification across sectors. We don't put all our eggs in one basket, especially not in oil, real estate, or any single industry that can crater overnight. Payout ratios under 80%. If a company's paying out everything it earns, there's no room for growth or emergencies. That's a red flag. Track records. We want companies that have actually increased dividends year after year, not promises, proof. Now, most people at this point would tell you to buy an index fund and call it a day. And look, index funds are fine, but they're averaging 1.5 to 2% yields. That's $75 to $100 on your $5,000. That's not monthly income, that's a coffee budget. We're aiming higher, but smarter. First pick, Realty Income, ticker O. This is the stock everyone knows, and for good reason. They call themselves the monthly dividend company. And they actually mean it. They've paid 650 consecutive monthly dividends. That's over 54 years without missing a single payment. Current yield? Around 5.5 to 6%, depending on when you buy. So if you put $1,500 of your $5,000 here, you're looking at $82.50 a year, about $7 a month from this stock alone. But here's why it's the foundation. Realty Income is a REIT, a real estate investment trust. They own over 13,000 properties, Walgreens, Dollar General, FedEx, tenants that aren't going anywhere. And because they're a REIT, they're required by law to pay out 90% of their income as dividends. That's not generosity, that's structure. The risk? Interest rates. When rates go up, REITs tend to struggle because their debt gets more expensive. But Realty Income has weathered every rate cycle for 5 decades. They're boring, reliable, and boring is exactly what you want in a foundation. One more thing, they raise their dividend every year, not by huge amounts, usually 3 to 5%, but it compounds. That's $7 this month becomes $7.20 next year, then $7.55, then $7.90. That's the power of dividend growth, and that's why this stock is non-negotiable. Next up, Main Street Capital, ticker MAIN. This one's different. It's not a REIT, it's a BDC, a business development company. They lend money to small and mid-sized businesses. Think of them as a private equity firm that pays you to own a piece of it. Current yield? Around 6.5 to 7%. Put $1,500 here, and you're getting about $97.50 a year, roughly $8 a month from this stock alone. But Main does something special. They pay monthly dividends, plus they throw in special dividends throughout the year. Last year, shareholders got an extra $1.20 per share on top of the regular payments. That's bonus income you weren't even counting on. Here's the catch. BDCs are riskier than REITs. They're lending to smaller companies, and when the economy slows, default rates go up. But Main has one of the cleanest track records in the industry. They've increased their dividend for 11 straight years, even through 2020. Even through every recession scare since 2008. And here's the kicker. Main's dividend growth rate is faster than Realty Income's. Over the last 5 years, they've grown payouts by an average of 4 to 6% annually. That's your inflation hedge. That's how your $8 this month becomes $12 in a decade. So yes, there's more risk here, but the reward? It's growth and income, not just income. Third position, energy transfer, ticker ET. Now we're in energy infrastructure, pipelines, natural gas, storage facilities, the stuff that moves energy across the country, no matter who's president, no matter what's trending on Twitter. Current yield? Around 7 to 8%. Invest $1,200 here, and you're pulling in $84 to $96 a year, about $7 to $8 a month. But here's why ET matters. It's a master limited partnership, or MLP. That means it has different tax treatment. You'll get a K-1 form instead of a 1099. It's slightly more annoying at tax time, but the yield makes up for it. And this is where diversification kicks in. You've got real estate with Realty Income, lending with Main Street Capital. Now you've got energy infrastructure with energy transfer. 3 totally different sectors, 3 different income streams. If real estate stumbles, energy might thrive. If lending slows, pipelines keep pumping. You're not betting on one horse, you're betting on the economy needing all 3 to function. The risk with ET? Commodity prices. When oil crashes, pipeline companies feel it. But Energy Transfer has locked in long-term contracts with customers. They're not speculating on oil prices, they're charging tolls, and tolls don't disappear. They've also been aggressively buying back shares and increasing distributions. Last year, they raised the dividend twice. That's confidence. That's management saying, we've got the cash, we're giving it to you. And that's exactly what you want in a dividend stock.
Last pick, AGNC Investment Corp, ticker AGNC. This is the one people either love or hate. It's a mortgage REIT. They don't own properties, they own mortgages, specifically agency-backed mortgages guaranteed by the government. Current yield? Around 14 to 15%. Yeah, you read that right. Put your remaining $800 here, and you're earning $112 to $120 a year, about $9 to $10 a month. But here's the truth, that yield is high for a reason. Mortgage REITs are volatile. They're sensitive to interest rate changes, economic cycles, and bond market drama. When rates spike, their returns compress. When rates drop, they print money. AGNC's dividend has fluctuated over the years. It's not a dividend aristocrat. It's not a buy-and-forget stock, but it's also paid monthly dividends for over a decade, through 2008, through 2020, through every crisis. And here's why it's in this portfolio. Because diversification isn't just about sectors, it's about strategies. You've got stable income from Realty Income, growth from Main Street Capital, infrastructure from Energy Transfer, and now high yield from AGNC. Yes, AGNC might cut its dividends someday, but right now it's contributing more monthly income than any other position in this portfolio. And if you reinvest those dividends back into the other 3 stocks, you're compounding faster than you ever would with a 2% index fund. Risk? Absolutely, but calculated risk, and that's the game. Let's add it up. $1,500 in Realty Income at 5.5% equals $82.50 a year. $1,500 in Main Street Capital at 6.5% equals $97.50 a year. $1,200 in Energy Transfer at 7.5% equals $90 a year. $800 in AGNC at 14% equals $112 a year. Total annual income, $382. That's $31.83 a month. Wait, didn't I say $41? Here's the thing. Yields fluctuate. Stock prices move. Dividends get raised. If you buy on a dip, your yield goes up. If you reinvest dividends, your income compounds. Within a year, you're easily at $40 plus per month. Within 5 years, with dividend growth and reinvestment, you're looking at $60 to $70. But let's be conservative. Let's call it $32 right now. That's $32 you didn't have before, from $5,000, with 0 additional work after you click buy. And here's the real magic. Next year, those dividends grow. Maine raises its payout. Realty Income raises its payout.
ET raises its payout, and suddenly your $32 is $35, then $38, then $42. This isn't a get-rich-quick scheme. This is a get-richer-every-single-year strategy. But here's what nobody mentions. This portfolio isn't passive forever. You need to check in once a quarter, maybe twice a year. Make sure the companies are still healthy. Make sure dividends aren't getting cut. Make sure your diversification still makes sense. Because markets change, companies change, and the portfolio that works today might need adjustments in 3 years. But that's not a bad thing. That's just being smart with your money. And here's the final truth. $5,000 won't change your life, not today. But $5,000 that pays you $32 a month and grows to $50, then $75, then $100, that starts to matter. Reinvest it, add more capital, let it compound. In 10 years, this isn't a $5,000 portfolio anymore. It's $12,000, $15,000, maybe $20,000. And your monthly income, it's not $32, it's $150 or $200. That's when passive income stops being a buzzword and starts being freedom. So here's your move. If you've got $5,000 sitting in a savings account earning nothing, you now know exactly where to put it. Realty Income, Main Street Capital, Energy Transfer, AGNC. 4 stocks, 4 income streams, 1 portfolio. Build it, let it grow, and watch your monthly deposits roll in. That's the video. Now go make it happen.